Good afternoon. This is Kathleen Anderson. I'm one of the client portfolio managers at ClearBridge, and we're excited to be able to bring to you one of our large cap value strategies to talk about today. I know growth has been on the mind for many, many years, but we're starting to see the value side of the ledger start to come to life, and have Dimitri Kakin on with me today to share our thoughts on our large cap value portfolio and just value as we see it out there today. Dimitri, welcome, and we look forward to having your insights shared with us today.
So, thanks for having
Dimitri, me. Yes, very excited. I know I'm based in Baltimore, so hopefully everyone's summer is starting off very well. We do have the cicadas here in the Mid-Atlantic, so I don't believe, Dimitri, you've been having to battle them in this beginning part of summer. Before we get into the strategy and speak, if you wouldn't mind sharing your background and Bob's background for the large cap value strategy.
Sure. Yes. So good afternoon, and glad to be able to talk to all of you here on the phone or online. So a couple of words in the background for myself and Bob Feitler. We co-managing the strategy together since June of '07. So I'm a first-generation immigrant from former Soviet Union, as my name might imply. So growing up under the communism sort of regime gives you a healthy dose of skepticism, which I think is a very good thing to have as an investor. When we first came here about 30 years ago, my family and I was fortunate enough to get into New York University and graduate with double majors in economics and computer science. I then worked at Morgan Stanley for about 3 years, and then I went to get my MBA at Wharton. And when I graduated in '98, I got a job working at Gabelli Asset Management as a telecom analyst. I worked there for about 5 years, and the interesting aspect of that experience was that it was during the TMT bubble period, for those of you who remember. So for the first couple of years of that experience, I felt like a genius because no matter what stock I recommended, they used to go up. And then the last 3 years were not as much fun because it was sort of the period of reckoning. And having that experience early on in my investment career was actually very valuable because you learn what's important and what's not important. And what's important is cash flow is important, balance sheet strength is important. What is not important is a sales multiple is not important, or how much dark fiber you have in the ground that is never going to be lit is not important. And then, obviously learning to build, sort of do financial analysis and being questioned by Mario Gabelli kind of on a daily basis and learning through with a lot of, bumps and bruises early in the career is also very valuable. In 2003, I joined Salomon Brothers Asset Management, which at that time was part of Citigroup Asset Management, and Citi then became ClearBridge Investments, as most of you know. I joined as a senior media telecom analyst. I supported multiple products, including large cap value strategy that we're discussing today, and in June of '07, I joined Bob Feitler as co-manager on the strategy. Bob's background is slightly different. He grew up in Midwest, graduated at Haverford College with BA in economics, so that's a similarity. My undergrad was economics also. And then he earned his MBA in finance at University of Wisconsin. He was a commercial credit analyst at Marine Bank, and that gave him sort of acute appreciation of risk and leverage. And as he went on to work in the financial services in the investment field. He covered the financial services industry, and that sort of acute awareness of risk involved in leverage is something that served him very well over the years. His family is also was involved in multiple sort of family-owned businesses, and he's always felt like an owner-operator type of mentality. And the other relevant point is that his father overlapped with Warren Buffett in college, and that brought Bob to sort of the world of investment and awareness of Warren Buffett well before he became sort of a household name. So he has attended multiple shareholder meetings over the years for Berkshire, and that really formed him as an investor. So he's been at Salomon Brothers Asset Management since '95, and we've been working together as co-managers since June of '07.
Great. Thanks, Dmitry. Yep. That's really, really helpful. And I should mention that out of our $184 billion of assets under management, you guys are responsible for close to $6 billion of the assets under management. And excitingly enough, we've been getting a lot of interest in our large cap value strategy. And one thing that I think is always helpful for people to understand is really what differentiates this strategy from other managers. We do have passive, we have ETFs out there, and a lot of Me Too type strategies out there that look to mimic the benchmark. Can you share kind of what you feel are the key differentiators for this strategy?
Sure. So the main difference is, if you think of typical value manager, generally many portfolio teams try to look for cheap stocks. So they do some kind of screen, maybe technical screen, the valuation screen, and look for cheap stocks based on price to earnings, price to book. Maybe they'll pick payout ratio, some kind of earnings yield, whatever valuation metric they use. And that kind of narrows the universe for them, and then they'll do analysis on the subset of these cheap stocks. We approach it from a totally different point of view in the sense that we look for businesses that have sort of strong moat, so strong franchise characteristics that operate in stable and growing markets. And then we try to buy them opportunistically at valuations attractive relative to the intrinsic value of these enterprises. And the benefit of doing that is that you create a portfolio of high-quality businesses that tends to do well over the market cycle with pretty meaningful downside protection, as I'm sure we'll talk about later on. So that's the main difference. So we don't start with cheap stocks hoping for reversion to the mean, but really start with identifying and evaluating the business model, trying to find strong franchises and buy them at reasonable prices, attractive prices. The other couple of points of differentiation, as Kathleen mentioned, there's plenty of opportunities to invest in whatever style box you're looking at a very low fee by buying index or ETF funds. And you get exposure, you get sort of market-like exposure, sector style box exposure. At a low fee, you get beta, but you don't necessarily get alpha through that exposure. So the point of active managers like ourselves is to have a concentrated portfolio that offers, fair amount of diversification and high active shares. So large cap value strategy at ClearBridge is about 50 names that we own. An active share varies between 75 and 80%. And the tracking error is about 2 to 4%. And the idea is that you have a high conviction portfolio where position sizes varies between probably 1.5 to 4% at market. High ROE, and a benchmark-like valuation. It is also a low turnover portfolio, so we pride ourselves being looking at investments as owner-operator, as I mentioned earlier. We're not really looking to trade stocks. We're looking to buy companies we feel comfortable owning through the cycle, and if there are market dislocations or hiccups, short-term in nature, we try to take advantage of them. And this time arbitrage that we try to leverage generally plays to our advantage. The turnover of the portfolio is about 10 to 20%. It obviously varies depending on what's going on in the market. If you look at the last 12, 18 months, it's a bit higher given the volatility related to COVID, but generally it's 10 to 20%. And we've been able to generate excess returns over the cycle with downside protection during the periods of weakness. And finally, being an active, fairly concentrated portfolio, you would expect most of the returns coming from stock selection as opposed to making sort of sector allocation bets or macro type of bets. And generally, it's about 60 to 70%, or sometimes even higher, of performance comes from stock selection.
Great. One other thing that I think is really important, and I guess we can either lean it towards a differentiator or also think about how you guys manage the portfolios. We do not only offer this portfolio in a mutual fund, but we also have an SMA. We do have an ESG version of this portfolio as well as an ETF. So really, when we think about the portfolio and the philosophy of the portfolio and the types of companies you look to hold, regardless of the vehicle, you guys apply the process across the strategy. So if you wouldn't mind kind of sharing the philosophy, the types of companies you guys look to hold across the different vehicles, share like how the team works together. How are the decisions made since you are co-managing the strategy with Bob? And then what are the resources that the team has available to you guys to help you surface ideas and maintain some of the names that you currently own within the portfolio?
Sure. So I'll start with the philosophy, and we'll talk about the team and how Bob and I work together and the resources. So philosophy, as I kind of highlighted already, is construct a portfolio of high-quality franchises with resilient and durable business models and attractive valuations. And what franchise means for us is what resilient means for us is company that have sufficient competitive advantage and balance sheet strength to withstand sort of inevitable bumps on the road. We've seen this during financial crisis. We've seen it in sort of industrial recession about 5, 6, 7 years ago. And obviously COVID sort of knocked everybody down in a way that was totally unexpected and unprecedented. So we don't necessarily position portfolio for a particular cycle or particular macro environment, but the idea is that you focus on this resilient business models that tend to do better in good times and bad times. Durable means that it applies really to both stability of the industry and the company's competitive position within the industry. So we try to find companies that have been around for a long period of time and not necessarily looking for somebody to reinvent the wheel. I mean, obviously things are changing, but the idea is not to buy something that is new and unproven, but rather to buy companies that have been around, have a brand, has pricing power, and the competitive position within the industry, because ultimately what we do is we buy earnings and cash flow streams. So while we focus on short and medium term or intermediate term cash flows, but we want to make sure there is high level of visibility in sustainability of those cash flows in outer years also, just by focusing on products and services that the company offers currently. We're not banking on some like new drug that is going to be approved 10 years from now, as an example. And finally, technology has become so prevalent in our everyday lives, whether it's broadband connectivity, cell phones, EV, retailing went through or is going through a process of massive transition. So we want to make sure that we understand and assess the risk of obsolescence or technological disintermediation, and we want to position on the right side of technological trends so that the technology is a friend, not a foe. So, and we spend increasing amount of time over the years on technology and obsolescence because it just becomes so important. And then when it comes to valuation, we look at valuation relative to the strength of the franchise based on normalized earnings and cash flows through the cycle. And as I mentioned just a second ago, we really heavily discount, unproven products and services. So it's sort of a Venn diagram, as you can see on the chart. Basically, it's the franchise strength, the end market strength, and the valuation, and that's really the overlapping part is really what we're focused on. Maybe a good example would be to talk about a company that fits really neatly into this approach and philosophy, and a name that we've owned for 10 to 15 years, probably even longer, that is a top 10 position in the portfolio right now, which is American Express. Everybody knows American Express. I think most of the people on this call are probably American Express customers and have been for years, if not decades. American Express has a differentiated offering by having about 70 million proprietary cardholders. And it differentiates itself so being offering superior customer service. It's a spending model as opposed to a credit model, even though they offer credit these days as well. And it's also an integrated approach in a sense that they're the credit card issuer, they're the merchant acquirer, and they own the underlying network. So the profitability of the company is materially better than a pure play credit card company. And at the same time, because it's fully integrated, it allows to have is enabled to have visibility into the customer spend and the preferences that are next to none. It's also very strong in small business. It's less risky because of its integrated model. And it's really well positioned over the long term to continue to grow and continue to gain market share. And as I'm sure Kathleen will talk about ESG functions or ESG kind of integration at ClearBridge, from ESG standpoint, and this is everything that we look at, every single company we look at, ESG is part of the overall discussion and company meetings. But from ESG standpoint, the approach that company takes is, treat customer fairly. The workforce is very, very satisfied. They pay well above minimum wage. They haven't really laid off any employees during COVID. It is also, founded Small Business Saturdays. It's, focused on the small businesses that are lifeblood of our sort of economy. It does a lot of things in terms of ESG disclosure and so on. So it's a company that fits really neatly, and we owned it, and we've added to it aggressively during the downturn recently.
Great.
So
thanks. Sorry.
Yeah. Sorry. So that's as far as philosophy, and as far as how Bob and I work together and the resources we use. So it's a joint core manager's position process. So Bob and I are equal core PMs. So every decision is a joint decision. Given his background, sort of in financial services, and my background in TMT, we each take leads in those sectors or multiple sectors of the market. But at the same time, we want to make sure that the other person is fully on board. And the beauty of having two portfolio managers on the strategies that you have two set of eyes and two ways of looking at things. Even though we aligned on the investment side, there's always good to have somebody else look at it so that we cover all the bases. At the same time, if you go back to one of the previous slides that shows the research group that ClearBridge is using, so we have a central research organization. Chuck Harris is director of research, and we have analysts that are listed here. It's a very well-resourced group. We continue to hire and backfill the ranks of analysts, and both Bob and I, being analysts, we're very familiar with the job of analyst is. We rely very heavily on analyst recommendations, but even if the idea comes from Bob or I, we generally vet every new idea with the analysts because they're our internal go-to expert domain kind of expertise is next to none. And you could be on a path of career sort of analyst if that's what you choose, or hopefully over time if you raise your hand and you say, hey, I want to run diversified portfolio, and there is an opportunity that matches your skill set, there is a strong history and strong culture at ClearBridge to promote people from within. Both Bob and I were analysts, as I mentioned earlier, so it's not unusual for analysts to get into the PM's position of managing money over time. So it's the management of ClearBridge under the stewardship of Terrence Murphy has been investing in various parts of the firm, including research side, investment side, obviously, sales and markets and technology and so on. So, and it's a very, very well-resourced organization.
Great. I appreciate your color on that. If you don't mind, if we'll go to the risk side of the ledger before we get to ESG, because I do think this is something that's very important in terms of how you guys manage the portfolio. So I think it'd be helpful to kind of help people to understand how you guys think about risk and what the impact of the portfolio's overall return profile is. And one other thing that I think is always helpful for people to understand is kind of what's the performance expectations out of this strategy, areas or markets where you guys will tend to do well and have really nice up capture. But fortunately or unfortunately, we do have time periods where the portfolio may struggle, and maybe help people understand when that might occur.
Right. So now that's a very fair question, and the one we get all the time when we meet with clients and consultants. So look, I mean, the objective of the strategy is to generate excess returns over the cycle, but there are certain parts of the cycle that we tend to do better than others. So, there's a chart. The chart that you see in front of you is a little busy, but I'll walk you through. And the reason we put that in a slide deck today is because it really hones in on a couple of things that are very important. So the top part of this slide shows the ROE, return on equity, of the portfolio relative to the one of the benchmark, Russell 1000 value. And you could see that since '07, which is when both Bob and I started managing the money for the strategy, there's been a consistent, call it 2 to 4, maybe sometimes even higher, ROE advantage for the strategy versus the benchmark. And if you look at the bottom part of the slide, you'll see that, and again, it's a little busy, but if you look at the dark blue and the light blue is large value strategy, light blue is Russell 1000 value. You see that you get this ROE advantage, meaning you get in better quality, higher return type of businesses without necessarily paying up for it. And that's really the trick. The trick is to get better businesses that are reasonable, attractive valuations without paying up for it. And when you put it all together, what it accomplishes is that it'll give you strong upside participation when things are going well, and at the same time, it'll give you downside protection when things are a little more rocky, as we've seen multiple times over the last number of years. And Kathleen, if you can just move to, I think it's the next slide that shows, yeah. So this slide shows 12 quarters it happens to be 12 quarters over 12 years, just coincidentally. The periods when the benchmark was down, some periods were very meaningful, some are more modest. But if you look at it for the performance of the strategy relative to that of the benchmark during the periods of drawdowns, on average, we outperformed by about 130 basis points. And that's really one way we think of risk is avoiding the blow-ups and offering this downside protection. Because things don't always play out as expected, and protecting capital on the downside is just as important as participating on the upside. But generally, the objective is to have an upside-downside capture ratio that is above 1. So in terms of performance expectations, you would think that periods of sort of sharp cyclical rebound when lower quality, more commoditized businesses that we tend to have, little, if any, exposure to, does better. In those markets, we would lag, and in the markets of, generally broader participation, we'll do competitively well, and we'll provide you downside protection when things are rocky. So if you put it all together, you have a strategy that tends to give you outperformance over the cycle with lower standard deviation, lower risk. And we've seen this multiple times, this type of performance. If you go back to great financial recession, 07, 08, 09, we gave you downside protection in 07, 08. 09 actually was a very strong year for us when, high-quality businesses bounced back first, and we've done exceptionally well. And then 2010 was sort of a catch-up trade for sort of lower quality, more junkier names, and we've lagged a little bit. But if you look at that period of 4 years, we've outperformed the benchmark. If you look at more recently during COVID, it's somewhat similar situation also. We've done better in the first 3 quarters of 2020 through the COVID sort of onset, through the bottom of COVID, and then when the vaccine was introduced in November, right after the election, and the first quarter of this year, it was sort of off to the races. The more cyclical, the better. The more compressed, kind of lower quality companies, the better. Those are not the businesses we tend to own, and because of that, we lagged a little bit. But if you look on a year-to-date basis, we're pretty much caught up with the benchmark, and hopefully we'll continue to outperform going forward. So hopefully that answers the question.
Yep, very, very helpful. And yes, you guys have definitely, since first quarter, the performance has definitely come in line with the benchmark. So done a very nice job as we've seen the market broaden out. Now, we have touched on ESG for a little bit throughout our conversation. So for those who may not know, we do fully integrate ESG at ClearBridge. So this is our 34th year of integrating ESG throughout the firm. And so essentially what that means is regardless if people are getting an ESG designated portfolio or not, all the companies that our analysts are recommending do get evaluated on their ESG acumen in addition to their fundamental analysis. The one thing that I consistently hear is that it is very, very hard to find an ESG value manager. So I think it would be really helpful for everyone to understand how you guys think about ESG, and especially in a large cap value portfolio. I know you talked a little bit about American Express, and we do have several examples that we can share, but I know we have Deere on here. But I think it would be helpful if you could address kind of how often you or the analysts or the team do engage with companies, what the impact can possibly be on valuation, and how we can help drive, I would say, sound ESG practices at these companies.
Yeah, so ESG is definitely a big area of focus in the investment community. As you mentioned, ClearBridge has had decades of ESG experience. It used to be called SRI, Sustainable Responsible Investments. It sort of transitioned, evolved into ESG. It's an area of focus for regulators, for investors, for clients, for company management. And again, it's not something we outsource to third parties, even though we have access to pretty much every other third party sort of data provider when it comes to ESG criteria or rankings. But the beauty of having a well-resourced, fundamentally actively managed platform is that you have analysts who know these companies that we look at inside out from the fundamental standpoint, and ESG is just a natural extension of what they do on a day-to-day basis. So even though we have specific ESG engagements with our companies, ESG are topics that come up on a regular basis, day in and day out, every time we discuss our investment opportunities and meet with company management. So it's not an afterthought. It's not an add-on. It's just we sit down with company these days virtually, and we ask them questions about the competitive position. We ask them questions about diversity and inclusion. We ask them questions about carbon emission. And if you look at the strategy, both ESG version of the strategy and the traditional large cap value strategy, it's ranked as an A by, let's say, a third party like MSCI, both ESG and non-ESG, and the let's say CO2 emission intensity has improved materially better than that of the benchmark. So, and the idea is that by focusing on these high quality businesses, you have companies run by management that makes long-term investment decisions and are good stewards of capital, and B, the companies has such a high level of profitability that they can do all the right things for all different constituencies. So it doesn't have to come one at the expense of another. It could be that they're competitive, like Deere, for example, that I'll touch upon in a few seconds. It's so competitively advantaged and so much more profitable that focusing on ESG is a natural extension, and it's also a growth driver. So it's not something that the company has to sacrifice. It's really oftentimes it's a benefit for the growth of the business. So let's spend a few minutes about talking about Deere. Deere is the largest agricultural and construction, most agricultural but construction company, equipment company in the world. It has a network of 5,000 dealers in 160 countries. And that's really the competitive advantage that's very difficult to replicate. So if you think about, most of us are not farmers, probably nobody in our families who are farmers, but maybe I'm making an oversimplified assumption. But if you think about farmer has a very short period of time to plant the crops and then to harvest the crops. And the risk of failure, if your machine is not working or you can't fix it fast enough, could be that you're missing on the entire year worth of sales and profits. So expensive proposition if you're in the farming business. So the dominant position that Deere has with the dealers give it ubiquitous coverage and access to, and the farmers have access to. And that's really very difficult to replicate. Deere has scale in terms of not only sales, but because it's so highly profitable, it can spend a lot of money on R&D. So it spends on average about $1.7 billion, which is multiples of what its next closest competitor is. And the beauty of that is that it can stay ahead of the curve when it comes to innovation, and increasingly so technological innovation. So we talk about being on the right side of the technology, sort of being a friend with the technology. Well, precision agriculture is all about technology. If you think about planting the seed in the ground, the depth that you plant it at and the space between two seeds are very important so that you maximize your crops. I apologize, my dog is barking. The beauty of working from home. Similarly, when you need to spray water, you need to spray herbicides and pesticides, and you can have technology such as See and Spray that Deere has been deploying over the last couple of years that minimize the use of wasteful and harmful chemicals, right? So the camera through the software with AI can learn to distinguish between the weed and the crop you're trying to grow, and the weed you're trying to kill and the crop you're trying to grow. So you can spray selectively as opposed to blanketing the entire field. And because of that, you can not only have a very positive ESG outcome, but you can also reduce your expenses that you need to spend money on in terms of buying chemicals and so on. So it's a kind of fits like a glove. The ESG and the precision agriculture is a growth driver. It's a market share gainer, and at the same time, it's very advantageous from environmental standpoint. So it's one of the same, and it's a terrific company. They've been doing precision agriculture. They started 15, 20 years ago. Their competitors are years behind, and hopefully that competitive advantage would sustain itself. So again, ESG is not an afterthought. It's fully integrated. We have multiple engagements with companies. Oftentimes, governance engagements generally happen at the time of annual shareholder meetings, but every discussion we have touches upon one or the other aspect of ESG. Another example of how ESG could be a very good driver for the business, for the company, is TE Connectivity, which is a top 10 position for us. TE Connectivity makes connectors, as the name implies. Connectors are used pretty much anyway. It could be used for data centers, for those servers and racks. It could be used in automotive industry, construction machinery. It could be used, so anything where there is any type of electricity that's going through, connecting to sensor or chip or something, there are connectors involved. And the company has a very strong position in automotive industry, which is about 50% of their business. TE Connectivity sells about $60 worth of content for traditional internal combustion engine vehicle, and that content doubles, sometimes even triples, for the electric vehicle. So we just at the onset, everybody knows about Tesla and the market cap that the company has. We just at the onset of the electric vehicle evolution, right, the battery electric vehicle. And, GM came out and said by 2030, 100% of their production is going to be electric vehicles. So we could buy GM, or we could buy sort of the arms dealer, right? We can buy companies like TE Connectivity or NXP that sells chips that benefit from the same electrification trend. And that's really, so we try to have a longer-term thinking and identify companies that are going to be winners, and they're winners not only on the fundamental side, but because this huge global secular ESG-driven trends that hopefully will benefit these companies and transitively will benefit investors in our strategy.
Great, very thorough. And I know there's many other stories you can share, not only on the valuation side, but the impact on the ESG side throughout the portfolio. So very, very helpful. Let's switch gears a little bit more directly to the portfolio. And what we're showing here is kind of the portfolio composition. And as you mentioned in your opening comments, active shares relatively, 75 to 80%. So very differentiated than the benchmark. So you guys definitely are not a index or a benchmark like type portfolio. But share with everyone kind of how you think about the areas where we do find competitively advantaged companies versus some of the other sectors that, again, may be a little bit more commoditized or cyclical that you might have a little bit more of a closer, I would say, allocation of the market, but still differentiated. So I think it'd be helpful for people to understand how you think about portfolio construction and composition in that sense.
Right. Now that's a good question. So look, I mean, we at the end of the day, we try to buy the best businesses we can buy at the most attractive valuations, and that principle, philosophical principle, we don't deviate from, regardless of what sector of the market we have exposure to. Having said that, there are some parts of the economy that are much more macro-driven or more commoditized. And in those parts of the economy, we tend to be a little closer to sort of benchmark aware, but at the same time, we still focus on better run, better managed, better positioned companies. So two examples of sectors that are more sort of macro variables driven, for example, are financial services and energy, right? The energy obviously is driven by the underlying commodity price, right, oil, or financial services is driven by sort of big macro factors such as interest rates or, unemployment, so much more economically cyclical. So we're not necessarily adversely positioned to cyclicality, right? Every business is cyclical, but what we try to do is we try to identify companies that are, despite of being cyclical, can earn their way through the cycle and are differentiated enough where we have high level of certainty that they're not going to have come back to the market to raise more capital to dilute existing shareholders, and they can maintain high level of profitability. So whether it's American Express that issues, credit card to companies, right? And credit is pristine now because the government has stepped in and helped consumers. But we know that the credit is not going to be as benign as it is, but we know that American Express over the years has been able to earn very attractive returns through the cycle, including during the downturn. Within energy, for example, we're looking for companies that are competitively advantaged. What does it mean for an energy company to be competitively advantaged? It's generally hyper-cyclical business, right? I don't care whether you buy an E&P, integrated oil company, oil field services, anybody who caters to that part of the economy is hyper-cyclical. So the point we're trying to make sure is that companies are very strong financially, so the balance sheet has to be top-notch, right? Because we know that the oil cycles are unpredictable and very vicious, and we want to make sure that the company can sustain itself through the downturn. And from an E&P standpoint, we want to make sure that the company is on the right side of the cost curve. So the lower the cost resource base, the higher profits are going to be at any point of the cycle. So ConocoPhillips, for example, is the primarily domestically focused E&P company that has very strong balance sheet and is in the right side of the cost curve. And that's really the only way we can position ourselves. We're not going to make a bet that oil is going to be up 20% or down 30%. We're going to be exposed to this part of the market because it's a relatively important part of the benchmark. So we don't want to be left naked. At the same time, we'll still try to identify the best positioned companies. On the flip side, in sectors such as communications, technology, discretionary, even within materials, we have been able to identify a lot of really high-quality differentiated businesses that we can make very reasonably aggressive positions. And if you look at the top 10 slide, I think it's right before the slide, you could see that, within, we talk about Deere, we talk about T-Connectivity. Sempra Energy is the utility company, right? You could say utility is utility. Well, Sempra is exposed to California and Texas, where there is a lot of Texas has a lot of growth organically, and California has a lot of renewables growth. So you can look at the company in aggregate, and it should grow its regulatory base at high single digits, trading at below market multiple. American Express, we talk about it. So there is a lot of opportunity to buy differentiated businesses, but we're a little bit more benchmark aware in sectors that are macro driven.
Great. That was really helpful. And yeah, we just put up the top 10 holdings here, and I think this is really helpful for people to see, a good portion. So a little over a third of the portfolio is represented here. Maybe something that people may not see unless they're looking at the full portfolio is a couple of names that may draw attention, especially when I give updates on the strategy. Microsoft and Apple are names that we own within the portfolio. Again, they're not in the top 10. If we think about how long you've owned Microsoft, and in some of your opening comments talking about owning companies for the long term, I think we've owned it for over 17 years. And then because of the valuation process that you guys follow, you were able to get an opportunity to add Apple to the portfolio in the summer of 2019. So I think it'd be helpful to share how you came to own and why you still own the companies. I know we've trimmed both of those names pretty markedly within the portfolio. So given, I would say, a lot of growth managers own it, how do you think about it in a value portfolio?
Right. So as I said at the very, very beginning, what we try to do is we try to buy great franchises at attractive valuation. Microsoft, as you mentioned, has been in the portfolio predating me when Steve Ballmer was running the show. And at that time, he was chasing latest and greatest as opposed to leveraging the core strength of the franchise, which is enterprise relationships. And when management changed in 2014, 15, I'm dating myself, when Satya Nadella came in as a CEO of the company, it went back to basics, and it's now one of the largest, most profitable software company in the world. We haven't bought a stock, Microsoft stock. We haven't added to our position since 2003 when stock was trading at, I think, $24, $25. And more recently, 2019 and early part of 2020, we've trimmed it aggressively, not because we don't love the business, because we do, but because valuations has gotten to the point where it's much more fully reflective of the value of the business. So it is still a position holding of ours, but a much more, it was a 3.5% at some point. It's now probably 100 basis points. So Apple is a little different because Apple is a name that we haven't owned until summer of 2019. And at that time, we were sitting down with our tech analyst, Deepan, and looking at the company that had overcapitalized balance sheet and was trading at a low-teen multiples because people didn't believe that the 5G cycle is going to be relevant and nobody wanted to look out, 12, 18 months. And we said, look, it's a very sticky business. Nobody's leaving ecosystem. It generates an increasing amount of profits from services and software, gobs of free cash flow, and very attractive valuation. So we bought it, added to it aggressively. It became over 3% position again, and we trimmed it again very aggressively, even more aggressively than we did Microsoft because of valuation. So the advantage of running a high-quality value portfolio that we have is that we can buy this type of high-quality businesses, and we just have to be sensitive to valuations and recognize that the upside may not be as appealing at certain valuation as it has been at the time when we bought the stock.
All right, my final question for you today is really just talking about this last year, probably year and a half, has been relatively volatile. As you mentioned in the beginning comments too, turnover did take up a little bit more because we did take advantage of some of that volatility. So maybe tie in your thoughts on the current macro climate. I would say, the value side of the ledger has definitely been performing a bit better, and people are asking, do we think it's durable? So I think it'd be helpful for us to close out on maybe any additional stocks that you think can benefit over the long term that we haven't already discussed today, where you've been taking advantage of in the portfolio.
Right. So I think Buffett, and I'm going to butcher the phrase, but Buffett said you want to be fearful when everybody is greedy and greedy when everybody's fearful, right? So periods of distress or massive sell-off usually creates a lot of uncertainty and opportunities at the same time. So if you look back during the COVID kind of in the spring and summer of last year, market was on sale, and we did identify and bought several stocks that hopefully will yield very successful results over the next number of years. So for example, we bought Lam Research, which is semi-cap company, one of 3 or 4 globally, with very strong long-term trends at a very, very reasonable valuation. We acquired a company called Vertiv, which is not a household name, but it's a play that they make equipment for data centers and cooling and equipment. So anything to do with data centers, corporate campuses and racks of equipment, dominant position in certain verticals, very reasonable valuation. At the same time, we were able to, we had a legacy position in AT&T from our ownership of Time Warner that we sold and we bought during the sell-off. We bought T-Mobile US, which has a competitively advantaged spectrum portfolio. So, risk and distress presents opportunity. More recently, what we've, given the unprecedented economic stimulus, both financial and monetary, that we are going through, just as a point of reference, cumulatively there were 3 stimulus bills, kind of like big buckets, 3 stimulus bills that were passed under the prior administration and so far, the current administration. In aggregate, they represent about $5.5 trillion, which is roughly, 25% of the U.S. GDP, which is about $22 trillion. So unprecedented amount of money being injected in the economy, and the rates are still very low. So what we try to do is we try to be aware of that and understand that there's going to be winners and losers, and there's going to be beneficiaries of that. So companies like Booking, as people go and try to get out once they're vaccinated and go back to travel, Booking should be the main beneficiary. A company like TJ Maxx, which is a off-brand retailer that should, continue to gain market share as the traditional, retailers' demise continue, over the long term should be, continue to do well. On the flip side, company like Raytheon Technology, which has become a top 10 position for us, the defense side of the business is very stable and cash flow generative. And once the planes start flying, the commercial aerospace business and aftermarket business comes back very strong, and the company lowered its cost structure during the COVID. So they should be main beneficiaries. So even though we are bottom-up, fundamentally driven investors, we're not really making macro bets, but we are cognizant of what's going on in the economy, and we're trying to, while focusing on this high-quality franchises and attractive valuation, we're trying to take advantage of opportunities when they present themselves. So hopefully that gives you some color in terms of how we position the portfolio. As far as growth versus value, I think one of the prior slides showed valuation discrepancy between Russell 1000 growth and Russell 1000 value. Not making a prediction that the gap is going to close, but trees don't grow to the sky. And that's right, that's the slide. So on the bottom of the slide, you see the dotted gray line shows Russell 1000 growth, and the light blue line is Russell 1000 value. And the gap is the widest it's been in close to 20 years. So, look, at some point, evaluations matter, and we don't need a lot of help to see this, high quality value stocks continue to do well, and that's the objective, and hopefully we'll continue to generate sort of sustainable competitive returns over the cycle. That's what we try to do here.
Thanks, Dmitry. Hopefully everyone got out of this as much as I did, walking through the strategy, the team, the philosophy, the process, how you guys think about portfolio construction, and weaving in ESG. Truly appreciate your time. For everyone that is tuned in today, we appreciate your time, and if there's any follow-up questions that you may have, feel free to reach out to your ClearBridge or Franklin Templeton representative, and we'd be happy to answer your questions. Thanks again.